Good morning, everyone. Thank you for joining our Nedgroup Investments Global Cautious Fund update for Q1. Today I'm speaking to Tony Cousins, who's the CEO and Portfolio Manager at Perford International, who are based out of London. During these difficult times, we've wanted to support and equip you to proactively manage your clients' concerns, and these telecons will be recorded and replayed and made available to be replayed at any point in time. We have shared this presentation slides with all participants, and if you have not received the presentation, it is available in the bottom of your screens. Please note that this call will also feature a Q&A, and if you are able to, please type in your questions into the dialog box on the screen below. We will endeavor to address as many of these as possible during the last 10 minutes. I would also just like to stress that these questions are anonymous and only the presenters are able to see these. The topics for today include a Q1 performance review. We'll also talk through the current positioning, and then we'll look at the outlook of markets for the rest of the year. So, Tony, I'd just like to thank you for joining us on the call. Thanks very much for calling in.
No problem.
Just to set the context for this morning, the first slide in the slide pack just demonstrates the broad sell-off of assets in this market and how there's been very few areas of the market which have actually provided protection. And Tony, I guess on this backdrop, I'll hand over to you just to take us through how the performance of the global cautious fund and how it's performed during these difficult periods.
Okay, thank you, Doug. Good morning, everybody, and thanks for dialing in to the call. I mean, as Doug's first slide shows, it's been a very brutal first quarter for risk assets. Now, I think those of you who've heard me talk before will know that we've been saying for quite a while that equity markets have been extremely expensive. This is what happens when central banks print $15 trillion of new money. Frankly, they've driven all financial assets to excessive levels of valuation. Now, I will not for a second pretend that we forecast the coronavirus and the pandemic, but what we did say is that markets were extremely overvalued, and when they are as overvalued as they were at the end of 2019, they are vulnerable. And that has always been the case. Expensive markets are vulnerable to sharp corrections. The catalyst was clearly the pandemic, the coronavirus. But the fact that they were so expensive in the first place is why they have fallen so fast and so far in such a brief period of time. And I'll come on to talk about how we have responded to that. But we went into this period with a very defensive portfolio. We had 25% in equities, which is the lowest this strategy has ever been in equities, because we were seeking to preserve our clients' capital and keep our powder dry for better valuations when they came along. So when we look at slide 3, the fund performance in Q1, disappointing top line number of 6% negative. We don't like losing money at Perford, but within the context of markets down more than 20, I think that's a reasonably creditable defensive performance. The two key sources of negative returns have been the fairly low exposure to equities. You see non-US dollar equities and US equities come out with a negative number. And also the exposure to unhedged non-US dollar foreign exposure. And I will come on to address that in detail in a few minutes. But you see those contributions to performance, minus 3.3 for non-US dollar bonds, non-US dollar equities, minus 2.9, and minus 2.1 for US equities. We had put some hedging in place. We run the non-US dollar exposure within a risk parameter of 0 to 45% of total fund. If we had no hedging on, we would have been significantly over that. So we had hedging on for the Australian dollar. That worked very well. The Australian dollar is very weak, and we produced a positive result from that currency hedging, which protected the portfolio to the tune of 1.7%. So those are the numbers for the first quarter. Our performance team worked hard to come up with preliminary numbers for the year to date, and those are shown on slide 4. And pleased to say there was we've eliminated half of that negative performance from the first quarter in the month of April. The fund returned on a preliminary basis about 3.1%. These are preliminary numbers, need to go through the full auditing process, but I think they'll be pretty reliable. And you can see the improvement in top line results from -6 to -2.9. Two factors really at play here. One, the dollar did weaken when the Fed started printing money again, supplying dollars into the market, and I will come on to what our expectations are there. And clearly there has been a rebound in equities over the period. So just finish up in quarter one. On slide 5 we go the key positives and negatives. I think I've spoken to most of these. The low equity weighting in the sell-off, that helped. The non-US dollar equity portfolio did outperform the markets in general outside the US, which reflects the effective high-quality nature of stocks that we own for you in this portfolio. Currency hedging portfolio from the decline in the Aussie dollar. We didn't get everything right. We could have made more money if we'd had a longer duration within the bond portfolio. The portfolio duration is extremely short. We have maintained that position because we are concerned that yields are just so absurdly low, you simply cannot make any money. And should yields rise, and they wouldn't really need to rise very much, there would be very significant capital destruction if you had long duration in the portfolio. I won't go any more into that, but very happy to answer questions on that. Final negative point was the one I've already mentioned, the unhedged non-US dollar exposure. So let's take a look at how we reacted to the sharp decline in markets. As markets fell very sharply, the facts clearly changed, and the valuation, overvaluation was corrected, and we responded to this in second week of March by increasing the equity weighting by 5 percentage points. This is shown on slide number 6. Our approach to this is to put in preordained trigger points based on value within our Bloomberg price feed terminal. Once those trigger points are hit, every member of the investment strategy committee receives an email, and the rule is we must convene an investment strategy meeting within 24 hours to determine what we are going to do about it. It's not just automatically putting in the money. A meeting must be convened, but these trigger points are very important because they are sort of preordained indicators in the cold light of day of what would constitute better value. In that second week, we hit that number. So we determined that then was the time to increase equities by 5 percentage points from 25 to 30% of the total portfolio, and that is what we did. We didn't get the absolute bottom. No one ever does get the absolute bottom, but it's clear that that has benefited the portfolio as current levels are now higher than when we we bought. We did put all the money into non-US equities at the time because those had fallen farther. They were already cheaper than US equities, and that valuation gap had actually improved in their favor. So that is the decision that we took to increase non-US equities by the full 5 percentage points. Now, just coming on to the currency that I talked about, slide 7 looks at the movement of the US dollar against 3 of the key currencies that you are exposed to within this portfolio. The Aussie dollar, Canadian dollar, and the pound. And because the Aussie dollar we had determined was the most expensive, that is the first currency that we had hedged to bring the fund within the 45% foreign exposure risk parameter. So that is the one, that was the right currency to hedge because that fell more against the US dollar than the other 2. However, we did have an unhedged foreign exposure to both the Canadian dollar and the British pound, and that clearly hurt the portfolio. So the question is, why do we have such large unhedged foreign exposure right at the top of our 45% limit? That's really talked to on slide number 8. This is how we value currencies. We use something called purchasing power parity. It is effectively a measure of export competitiveness. If your currency is overvalued for too long on this measure, then your exports will be priced out of the market and the trade account and current account of the country will deteriorate. This is not a good short-term tool for forecasting currency movements, but it is a very effective long-term tool. As you'll see from this chart, the red line is the measure of fair value, purchasing power parity. The blue line is the spot currency rate. The grey line, the grey shading, is 25% either side of the red line, which equates to about 2 standard deviations. And as you can see, the blue line always comes back to the red line. That is why it works, because of the effect on the real economy and exports. The important thing today is that, and what we show here is the British pound against the US dollar, is the US dollar is extremely overvalued. At its height in the first quarter, it got to over 40% overvalued against sterling. And as you can see from the history of this chart, which goes back to the early 70s, such a level of overvaluation is extremely rare. So I think it's very clear to us that the US dollar is the most expensive currency on the planet. Other currencies are significantly cheaper, and that is why we are prepared to have around about 45%, the maximum that we can have, according to our risk parameters, exposed to foreign currency within the portfolio. So, looking at how we are positioned today on slide number 9, we now have 30% in equities. I'll remind you that the cap here is 40% under the rules of this fund as a cautious fund. So we do have only 10 percentage points we can put it up, and we are currently holding fire on that. Our concern is that the rally that has occurred, particularly within the US equity market, is showing far too much optimism about the outturn for the economy and corporate earnings in the US, and valuations have returned to quite stretched levels in the US. Earnings have clearly dropped off very sharply. As a result, the prospective 1 year out price earnings ratio for the US equity market, the S&P 500, is now the highest since 2001. So earnings have fallen much more than markets have. And looking at another of our favored valuation techniques is something called the Shiller PE, the cyclically adjusted PE, which looks at market prices relative to 10-year average earnings. That indicator, while it has come down, is still higher than the peak of stock that it reached in 2008 before markets fell very sharply. So on valuation measures, I really don't think that the US equity market level where it is today is warranted. We have increased equities, but all into non-US equities, and we will be holding fire on increasing US equities until we do see significantly better valuations in that market. So that is where we are. In terms of bonds, we continue to have significant bond holdings in the portfolio, 28% in US bonds, 39% in non-US bonds, in quality markets, sterling, Canada, and Australia. We will not invest in low quality bonds, whether it's sovereigns or credit. But the duration of these bonds remains exceptionally low. You see market duration 1.05 years. These are not bonds that can make you a lot of money, but they will not lose you any money either, because they are so short. As we increase the equity weighting, we did need to put an additional hedge on to remain within that 45% level. So we are now hedged the Swiss franc, which is the next most expensive currency that you are exposed to after the Australian dollar. Final slide from me is on page 10. This is the precise portfolio to which you are exposed within this fund in granular detail. Really reflects in more detail the previous slide. And you'll see that I think one thing I would like to draw your attention to are the characteristics of the equity portfolio in the bottom right hand corner. Sorry, this has got a busy slide. That the yield on your equities is very significantly higher than the world market. The return on equity on your portfolio is also significantly higher. And the debt to equity is very, very much lower. These are characteristics that we always have within our equity portfolio. This is the representation of both value and quality. And the one I would like to stress very much is the debt to equity measure. We are debt averse at Perford in general, but one of the key problems of the last 10 years is the amount of corporate debt that has been raised. It's not everywhere, but it's particularly in the US. The supply of very cheap, plentiful money has encouraged companies to borrow a great deal of it. And the gap between the index and our portfolio in terms of financial leverage, in terms of debt, has never been higher than it is today. That is very concerning to us from a general market point of view, because companies are seeing a severe demand shock now, and in that environment you do not want to have a lot of debt in your portfolio. So just in summary, and I'll pass it then back to Doug for your questions, we're doing what we said we would do. We have been very defensive. As the facts have changed, we have increased the equity weighting. You have to be contrarian in this business. The duration of the portfolio remains very low. The equities continue to have those characteristics of value and quality, and within the strict risk parameters within which we manage the strategy, we have chosen to reflect the overvaluation of the dollar by having a significant unhedged portion to overseas currencies. I'll leave my formal remarks there. Hand it back to any questions you may have on how we're looking after your money.
Thanks very much, Tony. Tony's line did break up over when he was talking about the April performance, and there's been a question just for me to just quickly summarize what he was saying. So I'll quickly just go back to the slide. But effectively, the message that Tony was bringing across there was that there has been a recovery in the fund over April, and this has largely been driven by recovery in the equity markets, as well as which was compounded by the fact that the fund did increase its allocation to equities during March. And also, he spoke at length about the recovery of some of the currency positions in the portfolio, which have also driven the return on some of the non-US dollar bonds. Just to remind you again, we'll take the next 10 or so minutes just to run through some questions that have been posted. I would encourage you to post any further questions that you might have for Tony, if they do come to mind during some of the discussions. Tony, I'll work through a couple of questions here around global equity markets and why they haven't fallen, and around some of the allocations of the underlying funds. I'll maybe start with the allocation question first. We've just got a question here around the weighting of the fund to offshore property, but there is none in this fund. So maybe you can talk to why you haven't invested in property, and then potentially is this an asset class that is going to or potentially could look attractive in the future?
Well, we would not invest in direct property because this is a liquid fund, and we will not take exposure to illiquid assets. And while property is a perfectly legitimate investment in its direct sense, it doesn't fit with this strategy. We need liquidity so that when the facts change, we can exit positions, and direct property doesn't meet those criteria. What we could invest in are REITs, real estate investment trusts. We have owned those in the past. We don't own them today purely through matters of valuation. We had seen, as part of the financial asset inflation of the last decade, the yields on these fall to really absurd levels as property was bid up relative to the income that it provides, and we simply haven't seen those come down. Anecdotally, we hear a lot of evidence about tenants not being able to pay the rent or not being willing in that respect, and we're certainly seeing a lot of that in London. Tenants simply only paying a portion of the rent, or some of them paying none whatsoever, and that really isn't reflected in prices, but it is a legitimate asset class for us. We've owned REITs and property companies in Europe, in Japan, in Asia, and we would be prepared to do so again if the valuation was right. But right now, it isn't.
Tony, we've also had a question regarding equity valuations and the fall in equities so far. The question is more around why value type stocks got hit harder than growth stocks, and would you expect a more growth orientated stock to be worse impacted by potential economic slowdown?
Well, I think there's a particular anomaly at play here. This is a question we are receiving a lot because our equities performed. We're a value manager, and our equities performed very well through this period. I think the anomaly here is the financial sector. Our portfolios don't own any European banks. Many value strategies, the core metric for measuring value is price to book value. Now, banks, and particularly European banks, appear very cheap on a price to book value. and we haven't owned these for nearly a decade. The main reason is that we believe the book value being used by these banks is a great work of fiction. It is reliant on a series of accounting devices, many of which require assets to be held at cost, and all sorts of lax regulation in terms of risk parameters, so that banks are able to show risk-adjusted capital ratios which look quite respectable, but don't actually survive a forensic test of what's in them. Some of them include quite flaky forms of capital, like deferred tax assets. These are actually prohibited by the Bank of International Settlements for use in capital, and many European banks have been getting around this by having the governments guarantee them. These are quite illusory assets that may never see the light of day. So we think the book value has been massively overstated. We value companies on the basis of their dividend yield plus their ability to sustain that dividend and grow it. And on that approach, banks look very, very poor. And this is a big sector. And within value indices, it's about 30% financials within the sector. And that has been a massive value trap. And we think it will continue to be a value trap because this sector is under immense pressure. It has bad debts which are simply going to get worse, and it is unable to make a decent net interest margin because interest rates are so low and in a number of environments are actually negative. So this is a question, we've looked into it hard. We've outperformed markets in general, and markets in general have outperformed the value index. So the question is a very good question, and people say, well, are you actually a value manager? This really comes down to your definition of value. We do think that the growth stocks, the technology stocks, which have performed much, much better, remain extremely expensive. The Nasdaq is barely down this year in the US, and these companies will not be immune to the downturn, the economic downturn that we are seeing, and yet they are valued as highly as they were at the end of the year. So we think that they are very risky. We do think value is important, provided you define it in the right way. And very, very importantly, you stick to quality. There are a number of companies here that are likely not to be with us in a year's time. And that's because they have too much debt. And their decline in revenue and profitability will not enable them to service that debt. So unless they are bailed out, and not everybody can be bailed out, they will simply go to the wall, and you don't want to own those.
And I guess an interesting observation that we've made is that what you tended to see is your valuations are based on a dividend yield basis, and I guess a lot of investors would be targeting a financial type company for their dividend distributions. And with the regulatory interference that we are seeing, is particularly in Europe, which is effectively preventing some of the insurance companies and financial and banks from paying dividends, that whole valuation question has been brought under the microscope. And I guess that's another reason which has driven investors from those types of stocks. Tony, we've also got another question around just your outlook for inflation. There's been an incredible amount of I guess stimulus being pumped in, both fiscally and through the central banks, both in terms of in Europe and the US. Just wanted to get your insights into how you expect a potential recovery to unwind, and whether you expect it to be a V-shape or a more shallow recovery, and where you see inflation ending up at the end of all of this.
Well, you're absolutely right, Doug. I mean, massive, absolutely unprecedented government stimulus programs have been put up. I mean, in Germany, it's 18% of GDP. In the US, it's nearly 14% of GDP. In the UK, it's 12.5%. We can sort of go on. These are absolutely enormous. We've seen another $3.5 trillion printed in the last essentially 2 months, taking the balance sheet printing or balance sheets of aggregate major central banks from 15 trillion to 18.5. This is huge, and this is the bridge that governments and monetary authorities are trying to build to the other side of the lockdown. The real $64,000 question here is, how long does the lockdown last? Because the longer this bridge gets, the more shaky it becomes, and the governments simply do not have the power to bail out everybody. They are paying vast amounts of wages. Capitalism is essentially on hold as the government is picking up the wage bill. And frankly, they didn't have any alternative. This had to be done because if it hadn't been, we would be in the middle of a depression by now. The very difficult answer to come up with is just how rapid the recovery will be. If you listen to Donald Trump, which I wouldn't particularly encourage, you will be talking about a very rapid V-shaped recovery. We simply don't think that is going to happen. Governments and companies and individuals are going to come out of this with a lot of debt because their income and revenue will have been interrupted for a significant period of time. Now, the actual extent of the damage is going to be determined by the length of the lockdown. What we have now is a very severe demand shock within the economy, but the longer this goes on, the greater that it will migrate into a financial crisis by companies simply going bust. People will just run out of money, and they will not be able to operate anymore. Clearly, if they are still in operation and demand recovers, they can rehire all the people that they have furloughed. But if they don't exist, they don't have an entity to rehire them. So that's the key question. From an inflation point of view, this is clearly very, very deflationary, the actual removal of demand, and that is why central banks have been so aggressive in printing money to try and stave off deflation. In a world with so much debt, deflation is the very last thing you want. So we can see no near-term prospects of a rise in inflation. Longer term, this will be very, very dependent on the extent of the actions taken by central banks to try and deal with the aftermath of the pandemic. Rather alternative views of monetary policy have been gaining greater credence, known as modern monetary theory. They say there's no risk to the simple printing of money to finance government expenditure. This is called monetization of government debt, which has so far been happening in a relatively limited manner through the banking system. But if you actually go to central banks buying infinite amounts of government debt at issue, that changes the game. Also, if you get central banks printing money to distribute to the general population for consumption, again, that changes the game. That approach is highly inflationary. We've never seen it before, or we saw it briefly in the 20s in Germany, and it is a very, very difficult thing to control for central banks, and can very easily lead to inflation. Now, if that were to happen, I think that would be very negative indeed bond prices would collapse. With 0 to negative yields, they are not pricing in a rising inflationary environment. And I do hope that that does not occur, but there are certainly political pressures to encourage it to occur. So that's why the importance of independent central banks who act in a prudent manner remains key. But certainly in the near term, no significant inflationary pressure.
Great. We've got one final question. I think this is a question you get a lot at Perfid, and it's around your equity weighting going forward. Tony, can you see the equity weighting, or is there how can you explain to investors when they're likely to see their equity weightings being increased in this fund?
It will be lower prices. That's what will happen. When that happens, the economic news will be extremely bleak. I think I've been on a few of these calls, and one thing I often talk about are great buying opportunities of the past. If you look at the last 50 years, the great buying opportunities, three greatest buying opportunities were 1974, 1982, and 2009. Now, on each of those occasions, the economic news was desperately bleak, but they were great buying opportunities because they presented tremendous value. And that is the importance of a process, a value-driven process, which takes the emotion out of the decision and forces you to do what turns out to be the right thing. And that's what we employ at Perfid. And when value looks better and we have very clear metrics for what that involves, and as we did in the second week of March, if those levels are hit, we will go in and buy equities. And I've spent a lot of time talking to clients about this, because we run this GAR strategy in 3 different currencies around the world. Quite often the clients who were questioning why we didn't own equities 25% higher than where they are now are the same clients who are very nervous about us buying them when they're 25% lower. And that's the nature of sentiment in markets. It's Warren Buffett's cycles of fear and greed. But history shows that this is what you have to do. You have to be contrarian. When the value is there, you have to go and grab it. And when it isn't there, you have to be very disciplined. Don't let your client's money burn a hole in the pocket, and stay away from the risk. And that's what we do at Perfid. We've been doing this for 30 years, and it is a very, very disciplined, rigorous, process-driven approach. And I assure you, when those valuation levels are hit, you will see higher equities within this portfolio.
And I think it's also important to just remind clients that, this particular global cautious fund, we're not trying to shoot the lights out. It's a cautious growth vehicle that's trying to achieve a cash plus return with significant downside protection. So, you need to be very cautious around when you're going to increase those allocations. And I guess that's why Perfid was such an attractive partner for us to go with, given this capital preservation mindset that they've demonstrated over time. Tony, thank you very much for taking your time to come and talk to us this morning, and we really appreciate your insights and expertise. To everyone on the call, look, thanks again for joining us, and please feel welcome to contact us with any additional questions or concerns that you might have. And please be rest assured that during these times we are spending a lot of time working with our fund managers to understand how your capital is being managed. Just a reminder that tomorrow Julian Campbell will be speaking with Rob Johnson. They will be discussing the performance of the Nedgroup Investments Global Property Fund, and that call will take place at 10 a.m. Tomorrow morning. From the team and from Tony, we send our best wishes for the rest of the day, and we look forward to connecting with you again in the future soon. Thank you very much for your time. Goodbye.
Thank you. Bye.